It was such a fantastic budget yesterday. Rachel Reeves has got away with it, CJ, and she just allayed to everybody's fears about the gilt market and about rates. Aren't you happy this morning?
That wry smile.
I can't believe he said that to me. I'm in fact showing the red card because I've never heard such garbage in all my life. I'm going to have to be dragged kicking and screaming to do something with the FTSE 250.
We bought it for a certain reason. It hasn't happened. Is there another potential catalyst? No.
When out came the headlines, the gilt market rallied very strongly. And then out came we're taking it down now, and the market collapsed. So in a matter of minutes, people made or lost millions of pounds.
I kept on waiting for the big rabbit she was going to pull out of the hat. This incredible new spending and growth measure that was going to create tens of thousands of jobs. And it just never came.
But I call this the rearranging the deck chairs on the Titanic, or as my friend Rich said this morning, rearranging the debt chairs on the Titanic.
Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome to week 21 of the Art of Investing podcast, brought to you by IG, the global investment platform. So joining us today, Mr. Chris CJ Fellingham.
Hi, Rich.
And Mark Spice Holden.
Hi, Rich.
Now, this week was going to be a special about the budget. Was it a budget for the people or for the politicians? However, these two have just had an almighty debate at breakfast. Honestly, I thought we were going to get asked to leave. I went to the bathroom and the waiter asked me, "Are your two uncles okay?" So be sure to stick around because there are going to be some fireworks in the decision about the movements in the portfolio. The debate all about the S&P 500 and the outlook for US markets next year. So we will come to that. But first, as always, the Spice Market Review.
Thank you very much, Rich. I'm bracing myself for these arguments, but happy Thanksgiving, first of all.
Oh, well done, you turkey.
He's a bit grumpy, isn't he?
He is really grumpy today.
I stayed up most of the night trying to read that boring budget, and I'm just weary of listening to people telling me why to be positive. So I'm going bad mood uncle today.
Well, you know what they say, happy Thanksgiving, happy markets. And sure enough, the last 3-4 days have seen actually the S&P and equity markets have a good rally up. In fact, they've had the best 4-day run since May. And if you remember when we talked last week, they were having the worst month, I think, since March. And the worst sort of November since the great financial crisis. That's all turned around. Thanksgiving rally is underway. And obviously the baton should be handed to Santa soon after this afternoon's proceedings. The main reason why equities have actually had such a good run, there's been some dovish talk from some Federal Reserve. Dovish meaning that the people talking about it are more inclined to cut interest rates rather than put them up. They are more focused on growth, I would say, in America, rather than worrying about inflation. So the doves have been flying this week. The first guy was a guy called Chris Waller. He's known as a dove, so no real surprise there. And he was saying that because the employment data in the US looks like it's weakened quite a lot in the last sort of month or two, that he's inclined to put another rate cut in December. In 2 weeks' time, it's 2 weeks today that they will know whether they've done that or not. However, what really swung the markets was a guy called John Williams, who also sits on the Federal Reserve. He's known as a centrist, so he sort of makes his mind up depending on the data, and he can be swayed dovishly or hawkishly, which remember is to look more to put interest rates up rather than down.
You mentioned him being someone who's influenced by the data. Does that mean Waller isn't influenced by data?
Well, he is influenced by the fact he probably wants a job as the next chairman of the Federal Reserve.
Right, okay.
And he is now second favourite because there's a guy called Kevin Hassett who is now outright favourite because Trump's actually mentioned him, and he's now 50% chance of getting the chairmanship, and Chris Waller has fallen to 20%.
So there's two votes for a cut. But you go back to what you're saying about Williams, because I think that is important. He's not seen as someone who's influenced by the crowd or even by the Trump. He's somebody who is making up his mind. And what did he say, Spice?
So the only bit of data they've had, really, the Federal Reserve, that's relevant to now, there's a thing called the Beige Book, which comes out every 2 weeks before the next Federal Reserve meeting. It's called the Beige Book. It's pretty boring to you and I. Most of us wouldn't read it. Beige is probably a good description of the colour, frankly. But within that Beige Book, they've seen a big change in the outlook for employers and their hiring intentions. So they're basically saying, look, we're reluctant to employ more people. We will lay people off, but we want to do it slowly because we're still not sure about the underlying economy and we're not sure about how AI is going to affect us. But the underlying economic conditions have deteriorated and so has the outlook for employment. And that is what swung John Williams into being more dovish.
Just for everybody who's listening, that Beige Book then is compiled by the Fed workforce, the backroom guys, the guys who are really keeping an eye on what's going on in the economy. They're not looking at the data that comes out because there hasn't been any data. They're actually talking to companies in the region. So they've got a good feel. And that's the background that's supplied to every Fed governor member before the Federal Reserve meeting. So this is their background reading papers.
Absolutely. I mean, if you remember, well, it's probably worth reminding ourselves that there are 12 voting members of the FOMC, or the Federal Open Markets Committee, which we call the Fed. And that's led by Chairman Jerome Powell. There are 7 permanent members on there. And they then have 5 other regional members who are also voters. One from New York, one from Boston, one from Chicago, one from St. Louis, and one from Kansas. And they are the main voting members of the FOMC. Now, as we know, because Jerome Powell is about to step down in May because he comes up to his natural end of term, Trump has made it very clear he wants to replace him with someone who understands interest rates better than Jerome Powell. Apparently, to quote Trump, this is the easiest job in the world.
Spoken like a true real estate developer. I'm sure. Who basically borrows as much money as possible and wants interest rates as low as possible to service them. Wow. No conflict there.
No, exactly. But I mean, look, joking aside, there's definitely been a shift in the sort of rhetoric coming out of the Federal Reserve sort of voters this week. And that has had a marked impact on the expectations for the interest rate cuts in 2 weeks' time, which is on the 10th of December. If you remember when we spoke last week, the odds on that happening had fallen to just 30% for a 0.25% cut. That's now back up to 85%. And with it has come a swing back into positivity for equity markets and risk markets generally, not just in America, but all around the world. Principally in America being the main beneficiaries. So
Santa's on his way, is what you're saying. The sleigh bells are jingling.
It was starting.
Reindeers are running.
It was starting to look a bit worrying at the end of last week, though. There was that wobble.
What happened, of course, was the Art of Investing podcast bought back into the market, you see. That people were worried that we hadn't been in the market in fully, and they let us get back in. So well done, Chairman. What a great judgment by Chairman, I think.
And even our bear turned bull, remember?
Yes, of course, yes. Yeah. The man who bites the top off bears.
An Ozzy Osbourne of the team. But, I mean, joking aside, I think it was good timing or luck. You've got to be lucky sometimes when you're investing. But we did manage to sort of change our positions at Friday night's close, which, as you'll see when the portfolio come up, has been useful. There has been a little bit more data out there, nothing particularly market moving. There's been slightly weaker than expected consumer confidence in November. In fact, it's been the worst month for 7 months. So again, this plays into the fact that the US economy is slowing. There's mixed pictures coming out of it. And hence, seems to me likely that we will get this rate cut in December in 2 weeks' time. When we come to talking about all things AI and company-wise, we can't get away without talking about Nvidia again, which has been a very volatile stock in the last couple of weeks. They marched all the way up to a new all-time high, if you remember. It then fell promptly about 20%, has recovered since another 10. So we're about 10% off the all-time high and about sort of 10% off the recent lows. And this week's volatility really came about because Meta, who own Facebook, have decided they're in advanced talks to use Google's AI chips. So Alphabet, the company that owns Google, their shares were very strong. In fact, they're the best performing Magnificent Seven stock year to date. They're up about 70%. So they've been a huge performer. And they have an alternative to NVIDIA's GPUs or AI chips. They're called TPUs. I'm not going to go into the technicalities. I won't pretend to know anything about them. But basically, they use less fuel. They're more energy efficient, and they seem to do a pretty good job. And Meta are hedging their bets, if you like, by taking a chunk of these TPUs alongside NVIDIA's GPUs, which overall is positive.
Yeah, I think that's the important thing, is that there was so much pressure on Meta post their results around this CapEx spend. And Zuckerberg was getting serious questions. And the share price reaction, we know that Zuckerberg reacts to that share price reaction. So he had to let something leak. And this was a leak via the information website. And it's in 2027. It's not like there's any risk to NVIDIA revenues in the next 24 months. You know, we're talking about 2027 at the earliest. And the TPU works alongside the GPU. So this panic around NVIDIA that, you know, lasted about 4 to 8 hours, a little bit overblown.
Absolutely. You know, it's interesting, as you say, Meta are probably conscious they need to try and, say, alleviate some of the fears about costs that people have been building in there, or lack of revenues coming from all this spend. And, you know, if you look at the Magnificent Seven this year, like say Alphabet is up about 70%. And that compares with the S&P 500, which is up about 14% in local currency terms so far this year. But Meta, we're languishing at only up 2% before this announcement. Now they're up about 7.5%. So this clearly helped. It's interesting. 4 of the Magnificent Seven stocks have actually underperformed the S&P 500 this year. Only Alphabet, NVIDIA and Microsoft have outperformed it. And we have a go at NVIDIA. They're still up 32% so far.
So I think Mark's making a great point there, which is that the rally's been really dependent upon a lot of this technology stuff. But with now us moving towards a stage where there's more interest rate cuts being discounted, a more certainty around them, you know, we can argue about whether we agree with that or not, and that's what we were arguing about at breakfast, actually, but we'll forget that for a moment. The fact is that allows a rotation to happen in the stock market. So, you know, people will listen to us, and you hear that NVIDIA is down 10%, and NVIDIA is, Mark, correct, about 8% of the S&P?
Correct, yeah.
So, you know, in all, you know, that's quite a big hit to the movement. However, what's happened is some of the smaller companies, and in particular, you'll see part of our portfolio when we talk about it in a moment, Russell 2000 has had a great week as people have started to say, this is help for the normal economy of the US rather than these big AI companies. So we're seeing that rotation. That's healthy. And once again, is another sign, in my view, certainly, but I'm sure Mark and you share it, that with this Santa rally is starting to pick up some speed and is starting to drive forward. So that's a healthy sign.
Absolutely. Like, as you say, when, you know, in a week where NVIDIA is down 10%, up 10%, the S&P is up about sort of 2 and a bit percent. So overall, net pretty good. And there's been a mixed bag of sort of company reports this week. John Deere, who own the big tractors, you'll see all the tractors if you happen to get stuck behind them in the country roads.
Or actually down in Parliament yesterday.
Yes.
Yeah, they had a bit of a profit warning, because they're being impacted by the tariffs, and you know, so agricultural sort of products are doing badly. So farmers are cutting back on big capex spend, and the shares are down about 4%. Those of you who do lots of printing, HP, they blamed the rise in chip costs that go into all their products. They were down 3%. But Dell, on the other side, have been selling more AI service. They're up 3%. And then one that actually Rich probably shops at quite a lot, Urban Outfitters. They actually had a very good set of results. Abercrombie were up good, and Gap, and their shares are up 13%. So overall, we've had a mini Thanksgiving rally, I would say. Now bring on the Santa rally.
Bring on the Santa rally, indeed, and bring on the Santa rally for the Labour Party, because it was such a fantastic budget yesterday. Rachel Reeves has got away with it, CJ, and she just allayed to everybody's fears about the gilt market and about rates. Aren't you happy this morning?
That wry smile.
I can't believe he said that to me. I'm in fact showing the red card because I've never heard such garbage in all my life. Look, there were 2 highlights of yesterday's budget, in my opinion. Clearly, it's a personal opinion. 2 highlights. One was the leak at the start. How we managed to leak the whole budget out before the Prime Minister had even sat down from Question Time is beyond me. There's going to be a big question and a big investigation done on it. But it would be very funny if it wasn't so silly and so market affecting. I mean, at the time when out came the headlines, the gilt market rallied very strongly. And then out came we're taking it down now, and the market collapsed. So in a matter of minutes, people made or lost millions of pounds. And most people think it's funny. It's not funny. It's market moving information. So that was the first bit. I mean, it was quite an interesting to see. Never seen that before. Let's hope we never see that again. And the second highlight was Kimmy Badenoch's speech afterwards, where for once, I don't think she's a particularly impressive politician. She gave a very good speech, and that was extremely good to listen to. For people who aren't aware of how it works, the leader of the opposition has to stand up after the Chancellor sits down, and they've literally only heard what's going to happen in the speech. Well, not this time, because the OBR had told them all beforehand, so it meant that her job was a bit easier to really construct her attack lines. So that was quite interesting in its own right. So the budget itself. Now, once again, my view, but I call this the rearranging the deck chairs on the Titanic, or as my friend Rich said this morning, rearranging the debt chairs on the Titanic. This was a budget, in my view, to save the jobs of the Chancellor and the Prime Minister, and therefore a budget for Labour MPs. I cannot see how really anybody can think of it as anything other than that. And let me give you a couple of examples as to why I say that. I was listening this morning to the head of the OBR, the organisation that leaked him, and after his 5-minute grovelling apology on Radio 4 this morning, he made a couple of very, very good points. Spending is going to be 40 billion higher in the next 3 years than she said when she sat down this time last year. 40 billion more spending.
CJ, isn't that normally really good for an economy? If you're going to spend 40 billion, then you would expect that to be great for growth and really good for companies.
You would be forgiven to thinking that was the case, Mark. But let's just carry on, right? Taxes are only going up by 22 billion over that 3-year period, because the majority of the tax rises in this budget fall in 27, 28, 28, 29, 30, 31, which amazingly is when the next election is. So we're going to go into the next election having spent a load of money up front, then saying to everybody, I'm afraid you've got to pay for it now. I know, I want your votes, but actually I'm putting all your taxes up. So it doesn't make a lot of sense. There are 2 points here. Real disposable income, it's disposable income after inflation, is lower now and in the next few years than it was in 2008. So if you think about people, how do you normally feel wealthy? You feel wealthy because your earnings have gone up faster than inflation. You can buy a bit more. You can go on holiday. You can do whatever you want with that money. The amount of money you've got left after inflation is less than it was in 2008. Remember, the last government was kicked out when people pointed out the disposable income had gone up by 1% each year, in nominal 1%, so before inflation over the last 5 years. In this budget, it's forecast to go up by 0.5% in nominal terms each year. So this is our second 5-year period of appalling results for anybody who's trying to make some wealth or try to earn more money and to pay their bills. The second point, and I think it's just as important, the OBR have a little rule, and that little rule is that if any element doesn't beat their threshold of 0.1% effect on GDP, either positive or negative, they don't take it into account. OBR said this morning that there isn't one element of the budget that adds anything to GDP.
I kept on waiting for the big rabbit she was going to pull out of the hat. This incredible new spending and growth measure that was going to create, tens of thousands of jobs. And it just never came.
It never came at all. And OBR, who are there and having costed everything and priced everything and looked at the impacts of everything, say there isn't one thing in this budget that will increase GDP. Now, remember, this is a government who said it's all about growth. It's all about growth. If we don't get growth going, we're useless. We don't measure us on growth. We've now changed that completely. We're not that now. We are clearly now with a government who believes in putting up the cost of welfare. The people who are paying for it are the people who are in work. And that is not a recipe for success. And one of the reasons why I'm grumpy this morning, I've been arguing with these guys, is because I want to be optimistic. I'm always an optimistic person. Spice will always tell you I'm always optimistic. I'm always looking on the bright side. I was hoping that she was going to see the light and realise that if she gets growth going, she can afford everything she wants to do. Triumph of hope over experience, I totally understand. But at the end of the day, I found this to be a really, really, really depressing period for us. And to see everybody then going around afterwards claiming what they've achieved is just absolute rubbish.
Thank goodness 20% of our portfolio is not in the UK, Mark.
We will get to that in a moment. I mean, that's my view. And as I said, I'm a bit grumpy about it all. Well, what about you guys? What did you take out of it? Am I wrong? Have I got something wrong here?
I mean, I would say that, we were expecting that they would freeze the income tax threshold. So the level at which you have to start paying different levels of tax. That's been done by all the last 7 or 8 years by other governments. So we should have expected that. But then to say that they're not pushing up taxes is a lie, because by not increasing those thresholds, every time anyone gets a pay rise, it may push them into another rate where they have to pay tax for the first time, or even a higher rate tax. And so they're bringing loads of extra people into tax-paying mode. And, okay, that raises money. But again, it's quite depressing, particularly for lower paid workers who will get pushed into paying tax for the first time.
If I could push back once and then say what someone said this morning, it was this Chancellor who said at the last budget, I am not going to play those tricks the Conservatives played of freezing these allowances. It's wrong. It brings more people into the thing. I don't believe in it. This isn't the right thing. She extends for 3 years yesterday, number one. Secondly, one of the big organisations, I can't remember if it's the Roundtree Foundation or somebody like that this morning has said, if you look at the effects of putting up income tax or doing these income tax allowances, it would have been far better to put income tax up, because then that would be people who earn more money pay more, and you're not getting more people into the bands. And so she has completely changed her mind. I take it back 2 weeks ago when she, at 8:15 in the morning, told us we all had to do our share. She would always take the decisions in the best interest of the country. I cannot see how she's done that.
This is my worry. I opened by saying, look, this was a budget for the politicians, not for the people. Because who has benefited? The people who have been hit are investors with a dividend tax, and the companies have been hit. Workers have been hit with the
salary sacrifice thresholds. I mean,
students have been hit.
Oh, wow, yeah.
Again, with the thresholds on student loans. The only ones who have really got away with it are the pensioners. So this is why I don't understand why you're in such a bad mood.
Well, the pensioners haven't got away with it, of course, because the pensioners, some of them will have income coming in on their shares, and their dividend taxes have gone up. So, there are precious few people who haven't been impacted by this. But the people who haven't been impacted by it are the people who are receiving the welfare payments. And so it will create the narrative, without any shadow of a doubt, whether right or wrong, or whether they like it or not, that all they do is put taxes up on working people to pay welfare. Anyway, that's enough talking about the politics for all. It's very depressing. Let's talk about the markets and what they did, because I had one of those experiences yesterday that I thought I'd never have. I was listening to Radio 4 in the evening, trying to pick up what had I missed, what had gone on. Obviously, some massively good growth thing I'd missed. And Polly Toynbee from The Guardian was on. Now, Polly Toynbee is a correspondent for The Guardian, and she is on the left wing of politics. And the second thing she said was, look how well the gilt market's done. I have never in my life heard anyone on the left of the Labour Party talk about the gilt market. But they clearly had told everybody look what the gilt market's done this afternoon. What a great budget. And while I'm going on, and sorry for the continued rant, there were lots of announcements after the budget from JP Morgan, Goldman Sachs, and all these people saying what a great budget it was for growth. 2 days ago, the Treasury was announcing to all the banks, as we've left you alone, please will you make announcements after the budget to say how good it is.
Blackmail.
I mean, it's unbelievable.
Outrageous.
Unbelievable. But anyway, so let's talk about the market reactions. That's what I said I was going to talk about. So the gilt market on the leak of the OBR rallied strongly. Mm-hmm. Then they took the leak away. I presume they'd read a bit further down. The market collapsed. And then when the market realized that her buffer over her financial rules had gone from 10 billion to 22 billion, they said, wow, that's good. You know, we may not have to do some of this ever again. She's got some insulation there against bad times. And therefore, the market then started running again. So the gilt market in the end ended up about 8 or 9 basis points lower in yield. The equity market, I think, was worried about what might happen. And actually, what came out, although there wasn't anything for growth, there wasn't anything too negative either. The banks didn't get a special tax. You know, the gambling tax was only on online gambling and not on other sorts of gambling. So there was a few things at the edges where the equity market could say this isn't too bad at all. So the equities had a very good day and were up 1%.
You know, if we were looking at equities, we'd say, right, the FTSE 250 is relatively cheap where it is for the concerns around what that budget might bring. Because let's face it, we're all waiting 3 months for it to come out. Is there any way to price gilts in that sense? Was there a lot of fear that were keeping yields higher, and that might help the situation now?
So, all right. So there's 2 things you need to look at as far as the UK government bond market is concerned. One is that she's gone from a buffer of 10 billion to 22. So if you're sitting there saying, has she allowed for some things to go wrong a little bit? The answer is yes, she has. And therefore, all being equal, else being equal, that should be helpful to the gilt market. The problem is, as I said in my title of rearranging the deck chairs on the Titanic, we're heading towards the iceberg still. We're just going at a very slow pace because growth is going very slowly, but we're not improving our situation. We're spending a lot more and raising taxes. If we're raising the taxes a lot, where is the incentive for wealth creation? Where is the incentive to drive the country forward? Because the only way we get our debt burden down overall is to get our growth up. So if we're not going to get our growth up, and I go back to what I said earlier, the OBR have said there is no change over the forecasting period on the level of GDP from this budget, none at all. We are still heading where we were, and we're not improving our situation at all. So the issue for me is the market can say the numbers are a little bit better, so that's great on the one hand. On the other hand, it says, hold on a minute, we're not solving this growth problem, and without solving our growth problem, over time, our borrowing will get higher and higher. And you'll remember 2 to 3 weeks ago in the podcast, I talked about this OBR forecast for 50 years out, where if you assume nothing changes, what would it look like or what could it look like? And that took our budget deficit from around about 100% to around about 300%. Mm-hmm. So we know we have to improve this growth outlook. They haven't bothered doing anything about it.
Get 5% back on your investments. Open a new account and invest a minimum of £50 by the 31st of December and keep at least £50 invested until March. You'll get 5% on your invested value from 21st of November until the 31st of December. Your capital is at risk. New customers only. Offer valid until the 31st of December on ISA, GIA and SIPP accounts. Maximum payout £100. Terms and conditions apply. Right, I need some optimism here, Spice. So we've talked about the Titanic, right? What about Noah's Ark? What about the doves? You're my dove. I'm throwing out the dove here. Is this going to bring us rate cuts from the Bank of England?
Well, I wish I could be dovish. I mean, I think that the expectation for the 18th of December rate cut is pretty much unchanged because of the budget. I don't think it's increased or decreased. But I just want to give you some perspective, or the listeners some perspective about the costs the British government can borrow money at. So let's just take 10 years, and we're going to put this in perspectives. So a week ago, the yield on the 10-year gilt, or the interest that the British government would have to borrow money at, was 4.5%.
Okay.
On Tuesday evening, before the budget, it had risen to 4.7%. So people were clearly nervous that she was going to do something stupid in the budget. As of this morning, we're back to 4.5%. Now, you think that that's okay, but when you compare it to other places in the world, let's go to America first. The American government can borrow money for 10 years at 4%. And in fact, that's been coming down. In fact, everyone expects that it might just dip under 4% now. If you go to France, that we've had a go at because of all the political problems they've had, they can borrow money for, guess what? 3.5%. It's a whole 1% per annum for 10 years lower than the British government can. And that is the basket case in Europe, along with Italy, who are about the same, 3.5%. The Germans can borrow money at 2.7%, the Japanese at 1.8%, China at 1.8%. The only place that we invest in our portfolio that is worse than that is India, and that's 6.5%. But they've got 7% growth.
Yeah.
So guess what? They're growing. Who cares? We're growing at 0.5% if we're lucky. And we've got interest rates that are 4.5%. And India's growing at 7% and interest rates are 6.5%. Where would you rather put your money? I tell you what, I'd rather buy the Indian market, frankly. And
so there's the dove.
There's a dove.
There's the dove.
Sorry, I can't. The thing that really worried me about the budget yesterday was what it's doing to the housing market. And I expressed this concern last week. This country depends, I think, for confidence, consumer confidence, on house prices, because the majority of people in this country are lucky enough to own one house, or maybe two if they're lucky, very lucky. But either way, that house price inflation means that people's personal balance sheet, if you like, their feeling of wealth increases as the house prices increase. Now, obviously, if like my children trying to buy a house, that's a nightmare because you can't get on the property ladder. So what they did yesterday, we imposed a wealth tax, or a mansion house tax on anything over £2 million. Fair enough. You can say
it was tiny.
You can say that it's small amounts of money, and you can say yes, the people who are the most wealthy should do it. And there's going to be massive complications about this. There's going to be loads of appeals. They're not going to get money in as quickly as they think they are. There's no doubt about that in my mind. More importantly, though, they had a real go at the landlords who are renting properties, and they've increased their tax quite dramatically. And the problem with doing that is a lot of those landlords are probably going to say, do you know what? Sod this, we're going to sell the house. So
that's exactly what mine's saying.
They will probably sell, the second or third property or whatever they're going to do, come out of the market, put their money in, hopefully in the stock market, which will be better. And yes, house prices will fall at the lower end. And that's good for my children who want to go and buy a house. But for the housing market as a whole, you're killing the top end of the market. You're putting a load more supply and therefore lower prices into the bottom end of the market. What do you think is going to happen to prices overall? They're going down, and it's already a blimmin' mess at the moment. And so I think anyone trying to sell a house at the moment are going to be pulling their hair out.
But at last, we're going to get away from this crazy mentality in this country that your money should be all invested in houses. That doesn't happen elsewhere in the world. People invest in the stock market.
At the end of the day, you're talking about growth or not, what we should be doing in the country or not. At the end of the day, we can say as much as we like, we want lower house prices so people can get on the ladder, we need more supply, whatever. The effect of that will be to kill growth for a number of years. Right? That's what will happen. So it's fine, but that's what happens. It's a bit like taxing the wealthy. I mean, yesterday, another example, be careful of the yellow and red card, but yesterday they brought all the antagonism of people about a mansion house tax for £450 million. It's not worth it.
Over 4 years.
What on earth are they doing? I mean, if you're going to do it for a decent sum. It's just not even credible. That's just, we're in the politics of envy. We don't like you. You're going to pay more tax, right? But what it does is destroys the housing market. There was an article the other day, and I know you won't be too unhappy about it, but there's an article the other day saying that in parts of London, house prices are down by 15% in the last year. That's a huge amount of people who may have only just bought the house, who have now lost a load of money, who are sitting there going, well, I'm not spending any money. I'm not doing anything. What am I going to do? Right? And at the end of the day, that's not great for growth. And it's another, we talked last week when we had the experts in, what we want to do is get rid of stamp duty completely. That would have been really, can you imagine if we'd done all these tax raises, but got rid of stamp duty as well?
Fantastic.
This would have been a great budget. But I'm afraid we've got there's nothing for growth in here. There's nothing for wealth creation. There's nothing for entrepreneurs except more taxes in the next few years. And you've got to be, in my view, stupid not to think she's not coming back again next year and the year after for her little pet projects. And it'll be the rich who pay. And without the rich in this country, we have a real problem.
I tell you what we haven't touched on yet is cable. What about the effect on the great British pound?
Okay, so to me, and I think Mark and I are probably in the same sort of camp here, for cable, it's a relative game. Which is the most unattractive place out there against what's the most attractive place out there? UK's not attractive, but then Europe's not attractive. America, to some degree, with political risk, you might regard as not attractive. So it's a much more difficult call for cable, in my opinion. And so I probably wouldn't have a strong view on the currency here at all. As I said, my view is that bond yields will move after this little honeymoon, however long it lasts, of everyone going around shouting, "Oh, look at this buffer, it's 22 billion. Oh, look at this buffer, it's 22 billion." At the end of the day, market yields will go higher because people will say, "There's no growth here. How are we ever going to get this to improve?"
Unless inflation comes down.
Okay, so two risks to my scenario. Two risks. One Mark identified just now, which is if US interest rates fall rapidly and so US bonds rally a lot, that might stop the UK market selling off. It might just stay at this 4.5 level while 10-year US yields go to 3.75, 3.5. So that's one way. And the other way, where Mark has been, in fairness, quite a big player towards, is deflationary AI. So if all the impact of AI actually is more people have been made unemployed, more things being done efficiently, then inflation will be lower than expected. And that inflation being lower than expected will lead to lower interest rates. The problem with all that is that if there's all this unemployment and there's all this other stuff and inflation is low, growth will be non-existent. So that makes our numbers even worse. But it won't just be our numbers. The whole world's numbers will be worse, if we want to put it that way. So we'll be unattractive, but in a whole set of countries that are unattractive.
But with lower interest rates.
Than we have now.
Yeah, I think that there, as Chris identifies, there's a chance that other countries' interest rates, particularly the US, their rates fall much faster than we can. So if you look forward even 12 months, the most expectations are that we get 2 interest rate cuts. That's one in December, maybe one in sort of the springtime, if you're lucky in the UK. And that isn't great because remember, inflation in the UK is still up 3.8%, and the Bank of England has a target of 2% for inflation. In America, their inflation is sort of 2.8% or whatever, knocking on 3%, but beginning to come down. And they've got a target 2%. But remember, the central bank in America, we said this before, have a dual mandate. So they have to worry about inflation, but they also have to worry about trying to get full employment. And that's a major, major point and a major differential between them and pretty much every other central bank in the world. And that's in this world we might be going into, that I believe we're going into, with the greater efficiency from AI, unfortunately, rising youth unemployment. And by the way, over the next 5 years, most people are now thinking there might be 7% added additional unemployment in the youth. That's up to from 18 to 24. An extra 7% unemployment in that group of people, which is very sad, then, that will be deflationary. And that will also be work against growth. And, that cannot be good for the UK economy. In America, they can say, we are going to try and get those people back to work. And one of the best ways to get people back to work is to cut interest rates and cut interest rates and cut interest rates to stimulate growth, get companies to invest, borrow money, invest in new businesses. Yes, they may use AI, but they will find that AI will generate other businesses that we haven't even thought of yet that will come out of this. And that will start to increase employment again. In this country, our central bank doesn't have that lever to pull. They're not allowed to. That is not in their remit. But if we start to get deflation, deflation is the killer. It's the worst thing. Outright deflation, equity investors like me would absolutely hate, because if prices are going down each year, that is a killer for profitability.
So another thing just there quickly with what Spice is saying, which is absolutely right, is the other thing about the States, and, believe it or not, and we've had a big debate about this, the big beautiful bill. So they do their budget. And what does their budget do? Their budget comes out saying, I'll give you lots and lots of money, we'll get growth going, and then we'll pay for everything with the process of growth. We don't hear. We say we'll tax you now, and hopefully growth will turn up. Well, come on, guys. Which one are you going to believe? And that's why the US is in a better position than we are, because they understand you've got to get growth going before you can get the proceeds of growth. What you can't do is get the proceeds of growth before you get the growth.
So if you're on a spectrum from austerity, right, David Cameron austerity, to Trump's fantasy, where does this budget lie in terms of spending to create growth?
That's a really interesting subject in its own right about Cameron austerity, because I would claim there never was any austerity, number one. Austerity to me means spending going down. Spending never went down. Never went down. It's a big fallacy. It's a bit like saying the rich don't pay their way in this country. So the top 1% of earners pay 30% of the entire income tax proceeds. The top 10% of earners pay 60% of income tax proceeds. At the end of the day, what we want is we want the government spending to get out the way of private sector spending. And that's essentially what they're trying to do in the US, right? And that's what we need to do here. What we need to do is to say, yes, there is some really, really, really important spending for people who are underprivileged, who people find themselves in situations which they're on their downers, things have gone wrong for them. We need to be there as a society to support them. None of us would disagree with that. But there are too many people who are getting handouts now who are not in that position. And I'm afraid that's the problem. We have got to get on top of our public sector spending, so then entrepreneurs could come through and drive forward the growth that leads to better taxes, higher taxes, and better public spending.
Do you know what is embarrassing? I mean,
I got him going. I told
you got me on a rant. And, it touched me yesterday because my wife is Welsh, and I've got children who can identify as Welsh. And I know
I'm Welsh.
And CJ thinks he's Welsh. I know you're Scottish, so you got something to be. So you would have been annoyed that the Chancellor yesterday said that they're going to make 2 new AI growth zones aimed at boosting the tech industry and creating jobs, specifically in South Wales, where they're going to spend, to be fair, £10 billion on a growth zone over the next 10 years. So let's average that £1 billion a year. And you're still, that's okay. They say that's going to create 5,000 new jobs, right? So that's 500 jobs a year. 500 jobs, okay, not to be sniffed at. But we've just lost 180,000 jobs in the past year as unemployment in this country has risen. What difference is 500 extra jobs going to do? And then to add, injury, she actually made a statement saying that the AI investments in Wales are going to be complemented by a 10 million, not billion, £10 million investment in semiconductor technology. I mean, it's embarrassing. It's absolutely embarrassing. NVIDIA sell more chips than that in sort of 3 seconds. It's ridiculous.
I think it's time to move on to the portfolio, because we do have to remember we had the FTSE 250 for this event. So let's look at how the performance of the portfolio looks this week. If you remember, we had 2.5% allocation in the crypto and blockchain ETF, but we doubled that last Friday in the closing auction. Now, week on week, the ETF is only up 4.8%. However, from Friday night's close, it's up 14%. So that has given us a fantastic return there on the blockchain. And maybe, just maybe, we've managed to catch the lows. Russell 2000 was up 5.8% on the week. That's given us a nice healthy return. But total return since inception, that only turns positive now, up 4.7. Then it was the Nasdaq 100 with a 5% gain on the week. A reminder, we also added to that last week to give us a total weighting in the portfolio of 7.5%. Now, Spice, what about the losers on the week?
It always falls to me to have to do the losers. Thanks, guys. Thank you very much. Well, India, which, if you remember, had been the best performer the week before when we had the big down week, gave a little bit back this week, down 1.6%. And then the emerging markets was down about 0.3%, so unchanged really, as was cash. Emerging markets were still up about 4% since inception. So overall, a positive week. I think we're up 1.8%, which since inception leaves us 9% up.
And I think that's important to just emphasize that we talked about the Santa rally last week. We've got a bit lucky because they've suddenly started talking about more rate cuts, which has tied in nicely. But at the end of the day, that's what Santa rallies are for. So it was good timing, and we are, back up to 9%.
But after all this negativity I've been subjected to over the last half hour, what are we going to do with this FTSE 250? We had a specific catalyst and an event, and it hasn't panned out.
Yeah, I mean, the really disappointing piece is that we bought our 10% FTSE 250 because we felt it had a compelling valuation, very cheap, but there was a catalyst. And, I think it's important to explain to people that when you're buying into markets, you need a couple of things to be going your way. One of those is to have an attractive valuation. It might be an expensive valuation. You think it's going to go more expensive, but it's attractive to you. But there needs to be some sort of catalyst as to why it's going to work at that time. Otherwise, you get stuck in what's called value traps, which is where you say, I think this company is really cheap, I'm going to buy that, and it doesn't move for 5 years. I've got plenty of those in my portfolio. But, at the end of the day, you need two things, a catalyst and a valuation. So we got the valuation, and we put the money in because we felt there was going to be a catalyst. And, although yesterday, the more optimistic members of this team, Richard, have been trying to explain to me how this was good for UK equities and how telling the banks that they, needed to have a big campaign, people think will get everybody to buy UK equities. I think we have to admit that wasn't the reason why we bought it. We thought there was going to be something done on stamp duty. And therefore, we're in that really difficult position. And we're in a difficult position which many of our listeners will have been in, which is you bought something. It's gone down a little bit. I mean, it's not really moved. It's down 2.5%. It's not relevant, really, in that sense. You think it's cheap. You don't want to sell it. But the reasons for buying it have changed and gone away. Sounds a bit like what might be called a rabbit.
Okay.
And we know from our previous episodes that with rabbits, you should really shoot them. I really don't want to sell it because I think it's so cheap. And it could be there's a difference coming through. I'm torn a little bit by, discipline versus emotion. And we've sat here with Lee 2 weeks ago saying you got to get emotion out of things.
And hope is not an investment strategy.
Hope is not an investment strategy.
Because how do we feel if that's down 5% in the next week?
Very disappointed.
And rather stupid.
I'd say a terrible decision, Spicy. Here's what I would say. So my temptation is we've got to do something. But first of all, on that point, guys, I mean, we've got FTSE as well, FTSE 100. The FTSE 100 is really an international selection of companies moving in and I'm confident they will be performing well in the Santa rally. The FTSE 250 is really about the UK, and that's really the important distinction here. So I don't think I would be tempted to do anything with the FTSE 100 ETF, but I think I'm going to have to be dragged kicking and screaming, but dragged to do something with the FTSE 250. What would I do with it?
You've hit the nail on the head. We bought it for a certain reason. It hasn't happened. Is there another potential catalyst around the corner that we could cling on to? Answer, no. Ordinarily, falling interest rates would also help this market, and we've already expected that, but it was expected before. So that's not a new catalyst, that's an existing catalyst. And I see no reason, because of the budget, for that to be accelerated or any other things to come through. We're not going to get another budget for a year. That's a long time in markets.
Could there be an element people were holding back and waiting to get through the budget before they bought it?
There's undoubtedly been sellers of UK assets in the last 6-8 weeks ahead of the budget with capital gains tax worries and everything. I mean, people were just selling UK assets. So there's clearly a relief rally. Now, the problem is people have been selling UK assets for the last 6 years. Every month for the last 6 years, all the numbers show people are selling UK assets. So yes, there might be some relief based on that. but it's not a catalyst to see it moving. I think, in fairness, if I'm going to be honest, I think last year, after the budget last year, the next month was the first time there was a positive month for UK equities for X years, and the next month turned negative and turned down. So that showed this evidence, that showed people have been doing this in the previous budget, selling beforehand to buy back in the budget. And maybe that buyback, maybe the fact it was up over 1.5% yesterday, was those people buying back in. But the problem is, it's just a cheap market. What is the catalyst for making it not cheap?
Okay, let's look at it from the other angle then. It's 10%. It's a big part of this portfolio, so it's a huge decision. Is there somewhere else you feel that it would be served better?
I'm broken record on this, but we had a debate about it just now. The Americans are doing everything they can to try and get growth going in their economy. The natural beneficiaries of that are people being employed, getting wages, and companies and profits and share prices, therefore, ultimately. We don't have that. And I say they downgraded the growth expectations for the next for the rest of this year and early next year. And they've done nothing in the budget that we can identify here to do anything to stimulate that growth. We're at the whims of the global economy, and outside of America, places are struggling.
The counter to that, we're starting to rehearse the breakfast discussion, but slightly in a more respectful manner, maybe, is Mark's absolutely right in what he says. No doubt about that at all. But it's already priced into the market. You've already got the US market trading at massive multiples, but the UK market trades at a very cheap multiple. And that's where this problem with value comes in, because value investors don't want to sell things that are cheap. They want to sell things that are expensive. But actually, a momentum investor is someone who buys things that are moving in the right direction. No matter how expensive they are, you keep buying them because it's got momentum. And momentum has been a fantastic strategy over the last 4 or 5 years. So the question to me is, I think we've got to sell something. I don't really want to go and put it all in the US, because the US is pretty expensive in my book. We've got a reasonable amount in there already, you remember. And so my gut instinct is to put a little bit in the US. I think we've got to do some of that, because the Santa rally is definitely something that we expect to happen.
Yeah.
But would I put the whole lot in? I mean, the way I'm sort of thinking is selling 5% of the FTSE 250. When in doubt, chicken out. So rather than selling the whole 10, I sell 5. Then at least I can say I didn't sell it all until maybe the week after. So if we were to sell half of it, I think I'd be comfortable putting half of that into one of the US indices.
So you're talking about selling 5, but putting 2.5 into a US.
Yeah, I think I've got to put some of that in there, because I'm with Mark. We've got momentum there. It looks like the Santa rally is going. Hold on to the reins over the reindeer. So we need to be absolutely G'd up for that. And I'm thinking, what do I do with that other 2.5? I could put it in emerging markets. I could put it in Europe. I could put it in FTSE. I could put it in gold. I could put it in silver. I could put it in world mining or something like that. The reason I think more about equities is because I like the idea of the Santa rally. I'm probably thinking more about FTSE 100, actually.
Thank the Lord for that, because I've spent £100 on getting hats printed with FTSE 10,000 when it was trading at 9,920.
Yeah, oh dear. Perhaps we'll change that then. I'm thinking, and I can be swayed here, so guys, say what you think. But I think we've got to sell half of FTSE 250. I don't want to sell it. I hope I'm wrong. I hope I'm wrong to sell it. But I feel we've got to do that, because we said we were buying it for a particular reason, and we've got to show discipline. And I would put 2.5%. I think I would probably put it in the S&P 500, because it's the benchmark index. If the Santa rally is going to work, it's going to work there. And put 2.5% in the FTSE 100. Well, but what do you guys?
I was going to say, Spice has got his American flag wrapped around his shoulders and his pin on the lapel of the American flag. So why don't you have a go at choosing?
I mean, look, we definitely have to sell some of the mid 250. Yes, 5% or half of it is a good compromise, I think. But it is good discipline as well, as we've identified before. Personally, I'd put all of that into the US. I'd put 2.5 into Nasdaq and take that up to 10%, and another 2.5 into S&P. Now, granted, we only added to the Nasdaq last week. We put another 2.5% into it. So I'm happy with the S&P 500 being our biggest position. which would add another, if you added 2.5% to that, would become 12.5%. So I would be happy with that. Do you know, I don't mind actually putting extra money in the FTSE 100, because I think if international investors take fright at the budget and do sort of start selling off gilt yields, then the pound will go down. And we've argued many times before that the pound going down, ironically, is good for the FTSE 100, because so much money comes in from overseas earnings for those big companies like Glaxo and BP and Shell. And their profits, therefore, should go up. And we should get to that 10,000. That's the holy grail of 10,000 on the FTSE 100, hopefully before Santa arrives.
As we know, I moved into the bull category, joined my right honourable friend here from last week. So,
Friends or friend?
the chairman is the chairman. There's no friend of mine.
Okay, sorry, yeah, all right. He's no friend of anybody's.
I'm happy with that. Look, the 2.5% in the US, that's fine. That's clearly, that is going to get bought into the end if the retail investors have anything to do with it, as they has over the past year. I've got my hat, so I'm happy to go FTSE 100. But one thing that we didn't mention this week was that BHP came back in for Anglo American, and they had bid talks last weekend. And then BHP hurriedly said, when they got a negative response, they said, oh no, we're not interested anymore. But that is clearly a positive signal for copper for 2026, 2027. And we've talked about it. We need to talk about it more. We've only got 5% of our money in copper. So somewhere I would like to consider at going into next year would be to increase that copper position from 5%. That's not this week's, because rightly thinking equities for the Santa rally. However, I just wanted to mention that before it's forgotten in a few weeks' time, that copper could well be one to look at.
I'm with you on copper. I'm very bullish on it. I think that the fundamentals with this extra demand for energy and energy transmission that comes with the AI build out, I think is going to be very, very powerful, and copper is going to be probably one of the main beneficiaries in metal terms anyway.
Guys, it would be great if we actually could see, or actually did a bit of work rather, on how much copper exposure we've got within the portfolio, because we've got a 5% copper holding already through the ETF, and we have 10% in the BlackRock World Mining Trust. How much has that got in copper, guys?
So that's around 20% allocation. Remember, the majority of it, over 32%, is in precious metals. 20% of it is in copper. That's right.
So there's
isn't
a
it, Mark?
2% there. So we're talking about 7% of the entire portfolio is already in copper.
Yeah.
I mean, certainly something to think about. There's no doubt. I'm not scared of doing that, but obviously it's very volatile as a holding. And so we've got to think about how it fits into our portfolio construction. And
interesting you bring that up, because we had a wonderful email in from a listener this week, didn't we, that looked at the risk overall of the individual portfolio and how it sits.
Yeah, I had an email from a very good friend of mine, and Peter broke down our portfolio for us. Now, I suspect he thought that we were giving wealth management a bad name because he wanted to see what our risk actually looked like. But he actually broke it all down as a professional would break down the risk into the volatility within the portfolio. And actually, what it comes out to say is that the portfolio that we have has a volatility very close to the FTSE 100 overall. So if we took our whole portfolio and put it in the FTSE 100, its return characteristics would be very similar to the one we've actually got. Now, clearly, we don't own FTSE. We're talking about its return volatility characteristics would be the same. And so that was quite an interesting thing to see. Now, in this document, it also showed the volatility of all our positions. And when I say volatility, it's a measure of how much they go up and down. That's what people need to understand by volatility.
And so is that a way to judge your risk of the portfolio then?
Yeah, that's exactly the way that we're looking at it. So what we want to look at is look at the volatility of each of these holdings. It gives us an idea of how much it could move up or down at any particular time. No one will be surprised, I hope, to look and see that the VanEck Crypto and Blockchain Innovators Fund is very volatile and is almost as volatile as Bitcoin. I mean, that's a very volatile holding. The second most volatile holding on our list is copper. And that's why I come back to what we just said. So we need to be thinking about, yes, the fact we want to own copper, but the more we have of it, the more volatile our overall performance will look. And so we need to be thinking very carefully. This will be a subject of a podcast in the new year, how we look at the risk on the portfolio. But we've got to think about how risky each of these holdings is when we bring them all together. So, Peter, thank you so much for that. Keep it coming.
Thanks, Cobby.
Another email we've had this week is a great question from Gabrielle. With your portfolio performing extremely well recently, well done, Chairman, sir, joining at this stage, right? So he's thinking about investing alongside. And just a reminder, if you want to look more at the portfolio and see its performance during the week, it is available on the IG platform under Watch Lists, the Art of Investing podcast under watch lists. So joining at this stage makes me a little bit nervous about investing at the current all-time highs, particularly in areas such as gold and the Nasdaq. However, given my long-term horizon is 20 years plus, does it really matter what the price is now? CJ, what do you think?
It's a real challenge to answer that question, because if you remember back to 2 weeks ago when Lee was here, we were talking about the types of investors and what is important when you invest. And one of the things that he said, it was reiterated in the Deutsche Bank Research Institute's piece that I talked about last week, is that location of a trade is important.
The entry price.
So, and by that, I mean the entry price. Absolutely right. Thank you, Richard. So the entry price is important. That would mean then I'm never going to buy an all-time high, because that would be a silly thing to do. However, we also know from previous interviewees, when Charles Hall came in right at the start of our podcast series talking about UK equities and things like that, he made it clear that you should expect to see equities trade at all-time highs because earnings are going up over time. So therefore, share prices should go up. So you've got these two contradictory ways of looking at things. So my answer to that question would be, if you are looking seriously out 20 plus years, you shouldn't really care about buying it now, because over time, we've shown all the evidence on the podcast of how assets have returned. You will do fine. The difficulty comes if something is really highly rated now and is at an all-time high. So if someone told me, and of course I would say this, FTSE 250 or FTSE 100 or the DAX or something, would I be worried about them trading high? The answer would be no, because they're not highly rated equity markets anyway. So the chance of that being a high for a long time is very unlikely. It is more difficult when something is rated at a much higher level to be able to say that you won't have a setback before it then runs and takes out the high again. So, sorry, I'm sort of hedging my bets here. I would say, don't worry about it. Buy in if you've got a 20-year time horizon. That's the right thing to do, and that's what I would do in that position.
What about our king of momentum? You've bought a few all-time highs in your time, haven't you, Spice?
Yes, and hopefully a few more. I don't really fear, Frank, maybe naively, the all-time highs, because as Chris said, equities naturally should be pushing higher, not just because earnings are improving, but if you believe, like me, that we're going into this AI-led era of potentially greater profitability, greater efficiency, and then all the stimulus that comes from the One Big Beautiful Bill and tax cuts, etc., that I expect the US markets to be making all-time highs again very soon and to continue to push on. I've always said that I believe that you need a catalyst to end a bull market. They don't die of old age. Something comes along, and maybe you see it after the event, but something normally happens to sort of end a big bull run in markets. By its very nature, you can't see it until it's probably happened. But from where we sit now, I can't see anything that could push that off the cliff. And therefore, yes, I'd happily shut my eyes and keep buying it.
So the answer to the question essentially is, don't get put off by the fact we're at all-time highs. Go out there, close your eyes and buy it.
Great stuff. Thank you, gents. And if you have sent in an email, then just please bear with us, because we've had a couple of guests in the last couple of weeks and then the budget to get through today as well. But we certainly are taking notice of them. And over the next few weeks, we're going to make every effort to answer 2 or 3 questions at the end of the podcast as well. So keep them coming in. Gentlemen, to which email address?
The art of investing at IG.com.
And if you like what you've heard today, please give us a like and subscribe just below the podcast. If you really like what you've heard and you're coming back week after week, then don't forget, this is your last chance to vote for us in the Good Money Guide in the category under Best Financial Podcast. This is the last few days before the votes close. That would be very good of you. And thank you for joining us. We'll see you next week.